This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome to another episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. It is Tuesday, May 24th. We just had Victoria Day long weekend here in Canada. Nice time to rest and recuperate. And overall, kind of quiet as well in the crypto markets, Andrew. I think probably to a lot of people's surprise, there was some concern that the depegging of UST and the collapse of the Luna blockchain, token value at least, was going to have some knock-on effects into the rest of crypto. Now, it hasn't exactly been smooth sailing or happy days, but there doesn't seem to be any signs, at least right now, of spreading contagion. What's your take on how markets have traded in the past few days?
Yeah, there hasn't been sort of a liquidation cascade, as some people sort of called for. It's mostly been localized. So a couple specific VC firms and prop firms have gone absolutely smoked by this. There's some estimates that prop trading firm Jump Capital may have lost over $3 billion. A VC firm based in Korea called Hashed apparently lost $3.5 billion. And then besides that, a lot of retail sort of investors have gone obviously hurt by this.
Yeah.
But from what the crypto has mostly stopped its bleeding in terms of overall crypto prices. One area I do want to highlight that has been hurt sort of disproportionately is DeFi though.
Yeah.
If you look at sort of DeFi Llama, which is a sort of analytics site for all DeFi protocols,
yep,
the amount of value locked in the DeFi ecosystem has gone down by about 50% over the last 10 days, from about 260 billion to around 140 billion today, which is just a truly crazy decline, especially if you look at like the sort of long-term chart. So obviously a lot of that is also just sort of the Terra ecosystem itself collapsing, but
yeah. Well, like just to do the math, right? So you've 20 billion, call it, of UST, and then another 30 billion of Terra or Luna native token. Now, I know that UST was used in a lot as an asset in a lot of different like liquidity pools and some DeFi protocols, and probably Luna as well. But it seems like that alone can't, basically, like Terra plus UST doesn't come close to accounting for the decline. So where do you think the rest of it came from?
Yeah, I think it's a combo of three factors. So obviously Terra is the big one, the decline in crypto prices. So a lot of the collateral that's in crypto is obviously crypto. It's crypto assets. So if the price of crypto assets falls 20% across the board, then naturally TVL will collapse. And then finally, I think the third thing is that there's been sort of this is more subtle, but I think this is probably more long-term, is there's been sort of a shift away from traditional yield farming. A lot of people are kind of realizing that unsustainable tokenomics, which typically comes in the form of very high liquidity mining rewards and tokens, is not a very sustainable path for DeFi platforms to sort of take. And so we're starting to see a bit of a snapback away from subsidized growth back to more fundamentals, which I think is actually quite healthy.
And so what does that look like? So let's say you're launching a DeFi protocol, and if you're a DEX or something, you want to get people to put their liquidity into your protocol versus the next biggest. You offer like a bigger reward for doing that, right? And that we've kind of described this. You said subsidizing growth. It's like an incentive for early adopters to become stakeholders in the network, and it makes sense in the same way that people used to pay to acquire. It's like a pay to acquire customer kind of mentality. So what is a more sustainable model in your opinion?
Yeah, well, I think you need demand side driven growth. So liquidity mining can really only bootstrap the supply side. So it can do a little bit on both sides, but usually it's the demand side. So you're able to get people to provide liquidity to your DeFi platform, which then sort of services the demand side, which is what actually drives the fees back to the supply side, but also to the platform. So now what we're seeing is kind of a shift from growth to value, kind of what we're seeing actually in the traditional markets right now. So value investing funds have been doing far better than sort of growth funds because people are placing a higher sort of emphasis on short-term earnings versus sort of like long-term or long duration potential earnings growth. So we're seeing the exact same thing in the crypto sphere. It's less about just kind of headline TVL growth, and it's more about revenue, protocol earnings, which is essentially the earnings that go to the token holders, and what's sort of framed as tokenomics, which is essentially looking at how much supply are you issuing, your fully diluted market cap, which is something a lot of people just didn't even look at fully diluted market cap, which is kind of insane to me. But there's this meme in crypto, which is that FTV is a meme, which is essentially saying that the fully diluted market cap doesn't actually matter, which it does. It's incredibly important because it determines how people value the network. It determines future sort of dilution and everything like that. So anyway, so now we're sort of getting a snapback to sanity, I would say, in terms of how we value these things. Projects that actually have real innovation versus just kind of aggressive growth strategies are outperforming, and I think innovation is starting to be sort of valued higher than just pure growth.
Interesting. And does that mean that a lot of these copycat like protocols are kind of doomed? I mean, the model of simply saying like I'm going to offer what one thing does, but with a better yield, seems like not a sustainable model. And if anything, in order to be successful in this space, you've got to create a differentiated, product, basically, right? Which sort of from a business perspective does make intuitive sense. Now, lots of companies historically have been successful by offering what others do, but in a better way or with, more attractive, whatever, pricing, selection, et cetera. But in the case of these apps, it seems like to differentiate, you've got to go more unique, right? Is that the idea?
Yeah, exactly.
Well, you know a little bit about that, don't you, from your experience as the, what is your title exactly at SX?
Yeah, project lead at SX Network.
Project lead at SX Network. Yeah.
No, exactly. Like that's one of the things we've spent a lot of time focusing on is you want to have a new primitive. Like you want to have something new that differentiates you if you're launching a DeFi project or a DeFi platform or even a chain. So for us, where we're trying to distinguish ourselves is by using sort of the power of prediction markets to essentially create a new governance primitive. So without getting too much into it, but essentially blockchain governance is one of the least efficient sort of, I would just say kind of one of the weaker areas in the entire crypto space. Essentially you have these multi-billion-dollar DAO treasuries, which are either governed centrally by the core team, which kind of goes against everything that the space is for, or they're governed in this sort of direct democracy style where it's sort of one token, one vote. The problem there is that you have widespread voter apathy, no one cares, and in the end, sort of only whales participate.
Mm-hmm.
And it's also just, there's all sorts of issues like bribing and stuff like that. So what our tack with SX Network is prediction markets, which are kind of like betting markets, has historically have been proven to be more accurate than sort of individual experts, or in the case of politics, tend to be a lot more accurate than polls. And so the idea is that using the power of the market, you can essentially, in a way, crowdsource decision making, which is particularly interesting for governance, blockchain governance, given how sort of inefficient blockchain governance is right now.
Yeah.
And it's also done in a decentralized way, obviously, because a prediction market, a market itself is a decentralized sort of entity. But
the thing you're describing is futurarchy, right? This idea that we can use markets or prediction markets to do governance.
Yeah, exactly.
And I believe that you wrote a chapter for an upcoming book called Digital Asset Revolution, which is available for pre-order on Amazon now. I wrote the first chapter in the preface to that book. It's a collection of some pretty high quality research and work that's been done through the Blockchain Research Institute. So if you want to learn more about what Andrew's describing, I would encourage you to check out that book as well.
Yeah. I mean, you're good. You're able to fit in the marketing plug just in time.
Always be closing.
Yeah, no, totally. I think, and again, I think that's really cool because you can apply it to all sorts of, you can create all entirely new DeFi platforms just by having them sort of use this new governance primitive. It can also be extended to existing DeFi platforms. So it's definitely something that we spend a lot of time on.
So there's a lot of discussion recently about like, so where do we go from here, right? Like, what does this market look like? Is this a temporary dip, or are we in sort of a period of unwinding of enthusiasm or exuberance that's going to lead to a prolonged sort of bear market in crypto asset prices? And I don't think that there is consensus yet on that point, but there seems to be a growing chorus from certain corners of the market that, you know, we could be in for a quiet or rocky or, you know, whatever, bumpy ride here. So do you have any sort of insights on that from your own experience?
Yeah, I was actually going to ask you about that too, but I guess I'll start with myself. From talking to sort of VCs that have invested in SX and just sort of friends that I know, opinions definitely pretty split. I would say for the most part, most people think we're going into another sort of crypto nuclear winter.
A nuclear winter?
I don't know. I always call it nuclear.
Before the call, you said a crypto winter. It's a nuclear winter now?
Yeah. Well, I don't know. Maybe it's just a small crypto winter. Hopefully, it's not sort of a 3-year nuclear winter like we had from 2018 to 2021. Really. I mean, we'll see. But we're starting to see valuations come down quite a bit in the private markets. A lot of people, I know a lot of crypto hedge funds are trying to actually sort of shift their allocation from public market holdings into privates, mainly because privates aren't actually marked to market. Obviously, they're sort of just marked based on the round. And so
yeah, right.
It's sort of like I guess, a quasi refuge for people that want to keep you know what I mean? Like they're able to sort of shift their funds from something that's liquid into liquid. And it gives you kind of a better chance, I guess, longer term. And I know a lot of crypto startups are starting to cut back funding a little bit. I don't think we're there yet, though, just because there's been so much money raised in the last sort of 6 months. And from what I can see, there's a lot of VCs that still have a lot of dry powder. So, I mean, we'll see what happens. But I mean, personally, I'm sort of preparing our team for the worst case scenario. But I think there's going to be 6 months of pain. And then by the end of the year, things will start to pick back up.
Yeah.
It doesn't feel like we had the insane sort of run up that we had in 2017.
Yeah.
It was mostly localized to certain spaces like metaverse and NFTs. But there's not, like from what I've seen, like DeFi has been in essentially an 18-month bear market. So I don't know. It just things don't seem as extended as they did in 2017 when like DentaCoin was a $10 billion project with literally nothing. Coin for dentists. Yeah, so I think I guess what I'm trying to say is that at least from what I've seen, there's not as much craziness that needs to be, and a lot of things are actually starting to trade at what I think are quite attractive valuations.
Yeah, I would agree with you. Like, I don't know, in the last cycle, the types of projects that launched during the ICO boom were really early stage, quite speculative, with limited utility and limited user growth and limited users. And in some cases, they were like pre-launch, right? So there's a lot of hope in the market. And when that hope failed to materialize or did so on a slower time scale, people lost interest or became disillusioned with the whole thing. This time is very different, in my opinion. This time you've got numerous examples of clear product market fit in the crypto space, whether it's in DeFi or in NFTs or in stablecoins or any of these other areas. There is a hugely sophisticated market here that did not exist in 2017, 2018, and there are, many more users doing much more with crypto. Having said that, does that mean that there could be, a period where some of the air comes out of the market and, where things consolidate? Sure, absolutely. But in my mind, we're not anywhere near that, just simply because of the nature of the market. And actually, I think the same is true in equities as well. Like this now, obviously, the Web 2 world is more advanced than where we are in crypto. But people are trying to call for like a .com 2.0 here. And it's like, if you remember at all the kinds of companies that were around in the state of the internet in 1999, 2000, it's quite different than it is today. A lot of these businesses that are publicly listed have earnings, for example, and growth that is easy to sort of defend and backfill their valuation. So anyway, so it's all to say that, in my opinion, it all feels a little overblown. I long-term remain bullish. And like at 9 point, that is our view as well, which is that, this is a growth area. It's going to be volatile, but in the long run, it's growing, quite nicely. The other thing too, I'll add just about crypto is that imagine if, every single private company had like a daily mark or like a tick by tick mark to market, right? The valuations of private businesses during previous technology cycles would have like been all over the place, but that's not the way it works. So having this very transparent, very like immediate feedback of the market also means that people are hanging on to these prices like on a moment by moment basis, which probably creates more noise than it creates signal about what the long-term value is going to be. That's a really good segue to welcome our guest for today, Bill Barhydt, CEO of Abra, repeat guest, fan favorite. Bill, it's a pleasure to see you. How are you today?
I'm great. Good to see you, Alex. Always a pleasure.
Yeah. So we were just shooting the breeze about the market, how DeFi has been under pressure since the UST depegging and TVL's come off a little bit, but that overall, and while markets are sort of a little bit bumpy, overall, there doesn't seem to be many signs of contagion from that sort of episode into the broader crypto world, other than just a general sort of malaise in the prices. And I'm just wondering, we always love to hear from industry leaders and experts, and you're both in this case. What do you make of this sort of an open-ended question, but the state of the markets today? Like, what's your best sense of what's going on here?
Well, I think there's a lot of confusion, and macro folks don't like confusion. So on the one hand, Bill Ackman saying that inflation's out of control, and if the Fed doesn't proactively address this, even at the expense of a deep recession, then the markets are going to deal with it for him or for us. I actually tend to think that I tend to see, based on the current state of the bond markets and everything else, that the bond markets and the oil markets may have actually done the Fed's job for them already. I think inflation is coming down where it's peaked. Inflation is a lagging indicator, right? Yeah. So it's bad, meaning prices are still very high, but the rate of change has either slowed, gone to zero, and may go slightly negative. Now, remember, if inflation falls, we could still end up at a point where real inflation, not the nonsensical CPI numbers in the US that we use, but the real inflation could be 10%, but it's just not growing anymore. Okay, so let's put that all in context, right? So you could make the case, to Ackman's point, that real rates need to be probably 10 to 12%, which is not going to happen in order to tame inflation. But if the Fed is concerned about full employment and a certain amount of inflation and GDP growth and not being in a recession, then they're probably going to slow down and basically say, well, inflation stopped and is coming down because, for whatever reason, we've already tightened, or they're not going to claim that the markets did their job for them. But I actually think that the markets are basically in a correction mode. I think we're in a recession now. Whether they call it that or not, based on technicalities, I don't know. But the most important point here is the markets don't like confusion, right? Because half the people think, the Fed's got to tighten more because inflation's out of control. I don't think that's the case. As I said, it's a lagging indicator. And another half think that, we're already in a recession. So that's not good. And like I said, until we have clarity, which I think is going to take a while, I think it's going to be ugly for equity markets. I wouldn't say surprised, but I'm cautiously optimistic that, crypto, which is way more volatile than equities, but in March of 20 started tracking equities, hasn't really fallen significantly more than it has. And that gives me hope that should we get some clarity that crypto will have a very strong recovery. But what do I know? We'll see.
Well, we'll see indeed. And, it's so interesting because for the longest time, Bitcoin had a low to negative correlation with most other asset classes. It sort of marched to the beat of its own drum. And then we've been seeing, especially in the last 6 months, that it's starting to trade more and more in line with equities and more specifically, actually, with like the NASDAQ FANG stocks. If you look at Bitcoin, it actually kind of looks like it's like the B FANG, right? It's about the same size, $700-800 billion market cap. It's down about the same amount, 35 to 40%, year to date, and seems to be trading in that way, which in many respects kind of deals a blow to the store of value trade, the idea that it is independent. But again, like 2 months of correlation does not make a market long term. Like you have to, in my view, and I think you share the same view, Bitcoin is growing into that role, and it takes some time. But it's almost like now that the correlation is high, we almost want it to remain correlated because probably equities and other assets are due for a bounce. We're seeing yields rolling over. To your point, they were ripping for a while and taking a lot of steam out of the markets. Not to get too on the economics and macro, but companies are taking down their guidance. The inventories for retailers is going through the roof. Like clearly people have stopped buying stuff, and they're worried about all sorts of issues, whether it's inflation or job security or whatever. And that seems to be doing the job for us. So if and when, and who knows, we see the stock market and specifically tech bounce, you almost want Bitcoin to trade with it, right? It would be a shame if it became uncorrelated at this point.
Yeah, sure. I suspect you're right there. I don't see how that would change until there's clarity in the markets. And I think that's the reason for the correlation is basically we're just risk off on anything that doesn't generate cash flow. In that regard, I think Ethereum's an interesting investment, but it's not generating dollar cash flow. It's in generating Ethereum cash flow. So yeah, I think you're right. I think that once we have clarity and it's game on again, I mean, some of the valuations we're seeing are just crazy low now. I'm no fan. I'll be honest. I'm no fan of Coinbase, but at this price, I mean, given the cash flow, it's crazy. So I do think that the second people feel that there's either a bottom, and by people I really mean the institutions first, because retail will come second. But I do think we're going to see a V, and then anyway, I think that the Fed has created a nightmare scenario here for themselves, and we're all paying the price for that now.
Yeah, and you mentioned Coinbase. I totally agree. Coinbase stock was, I think, almost got below a $10 billion market cap at one point, which seemed incredibly low for essentially the largest exchange in the US and kind of the most blue chip public stock you can own in the crypto space. Yeah. Without getting too sidetracked, one of the reasons for sort of Coinbase's decline was this recent disclosure they had to make, saying that in the event of a bankruptcy, they could theoretically have to take people's coins. I'm just kind of curious, from talking to people that I know, it actually caused a bit of a panic. So people essentially taking self-custody of their coins. I'm just kind of curious, what do you make of that, I guess, recent disclosure? It sort of got walked back by the CEO, and whether that's actually a good thing in the sense that it's sort of forcing people to take their coins off of
bizarre. I mean, it's bizarre. If you manage custody, we're all regulated the same way in the West, more or less. If you're a money transmitter or a trust, which kind of, usually full custody, no fractional reserve, the laws are the same. You must maintain 100% reserves, and those funds are segregated. If you're hypothecating, that's a different story. They're not doing that, to my knowledge. So I don't really understand the need for that disclosure the way it was framed. I think a better disclosure would have been, hey, we are operating under trust or money transmitter laws in the United States. And as such, we maintain 100% reserves for those funds. I wouldn't be surprised if Brian didn't even know that change was being made, because it's kind of buried in terms of service. I I don't know. I have this thing where I actually really do read terms of service. I'm not saying that it's, I'm not judging CEOs who don't dig in. It's just something that I feel is important personally, but I wouldn't be surprised in this case if he didn't even know until the first CoinDesk or whatever article picked up on it. I really don't know, but it didn't make sense in general. But I don't think that really is any of the backdrop for any of these macro issues. I really don't think that that's why Coinbase's stock tanked. I think it's just more volatile even than FANG because of the fact that, like you said, it's crypto and then should have a much sharper recovery, which is why ARK and others are loading up right now, which is, if you have conviction, is what you should be doing.
Yeah. Yeah. Interesting. Speaking of, you mentioned, we're talking about Coinbase, and I'm curious from your perspective, as the CEO of Abra, what have you seen like on the platform recently? What are the big trends that you're noticing? And then another thing too, which is, obviously algorithmic stablecoins took a credibility hit because of the depegging of UST. And maybe a lot of people are looking at these lending opportunity or these opportunities to earn yields in crypto as maybe not the free lunch that they used to be. Now, obviously, what you offer is very different from a DeFi protocol, especially one like Anchor. But still, like, what has the activity been like, and what are your customers saying about all this?
First of all, if you're not generating yield based on cash flows or loans, it's magical money.
Yeah.
And so I don't care whether it's crypto or bond markets or whatever. Okay. It doesn't matter. So that should be the first question. If I'm earning X by depositing Y, where is X coming from? And if I can't understand the answer, give me back my Y and I'm out of here. Right. And that's just basic common sense, by the way. I'm not picking on Terra, although they deserve to be picked on right now, or Anchor, I guess, which is where a lot of people had their money, which is why they lost twice. They didn't realize that having money in Anchor was actually a leverage bet on Terra, because if one fell, pretty much the other one fell as well. And so people lost money twice, because I had some friends who were using Anchor like a personal bank account and were separately invested in Luna, not realizing that they were effectively leveraging themselves on the same bet, which is really horrible. The Luna wasn't as bad because it was more of a small crypto allocation, but a lot of people were using Anchor like a bank account and actually saying they were, which is just doubly crazy to me.
Yeah.
Anyway, so I think that a few things are going on here. One, first of all, at Abra, we do invest in a certain amount of DeFi. We tend to focus on coins that are basically using the initial allocations either for distribution, which were very, very short term in and out. And we don't do a lot of that, very small amounts. And it generally has to be a protocol we have some conviction for, because otherwise, like I said, it's funny money. And so we do like DeFi protocols that are facilitating liquidity pools and true lending. And I think that has a very big future. I'm sure you guys, given the show, you talk about it here all the time. But the majority of our book today is a combination of institutional lending, mining, operation lending, retail lending, all highly collateralized, and some DeFi. We didn't have any losses related to UST or Luna related to anything on the consumer lending side. On the consumer earn side. We did support Luna as a token. And so we had some people who themselves had Luna positions, and obviously that didn't work out well for them. And that sucks. So I think that in general, the idea of an algorithmic stablecoin, back to your other point, is definitely compelling. Okay. A lot of people don't know this, but actually Abra created the first stablecoin ever in crypto land. It was based upon Bitcoin back in 2014. With the term stablecoin didn't exist. We just called it a synthetic dollar, and pegged the value of the dollar to Bitcoin. And the idea was to use that for moving Bitcoin around and facilitate money transfer. And you can actually create, in theory, a stablecoin out of anything, right? Meaning anything whose the underlying asset is liquid, and hopefully that doesn't have a high risk of going to zero, you can create a peg. All you're basically doing is shorting the underlying asset, and you basically forego any upside, but you also forego any downside. The only situation in which that doesn't work is if the underlying goes to zero, because then you would need an infinite amount of that asset to maintain the peg. which is basically what happened with Luna. So using a new, unproven, volatile asset that has a reasonable chance of going to zero is not a good idea for a stablecoin of any kind, okay, or any synthetic asset for that matter, especially not a stablecoin. But if you were to use, let's say, Ethereum or something like Bitcoin is hard because it's not programmable directly, but Ethereum is, right? Maybe Solana in 3 or 4 or 5 years if it becomes more stable and proven, and we believe it's not going to zero. But there's always a chance that Ethereum goes to zero, right? So anyway, the idea of a decentralized algorithmic stablecoin is actually compelling. And if you understand decentralization, the reasons why should be obvious. So the question is it technically feasible?
Yeah.
The answer, in my opinion, is yes, it's technically feasible. The biggest risk is exactly what we saw, and that is the value of the asset being used to maintain the peg effectively going to zero, because they simply had to print an infinite amount of it. They got caught in this positive feedback loop, and the next thing you know, it went to shit. But if you could do it, like I said, based on something like Ethereum, it could work. And then the question is, what's the mechanics? What are your incentives? Et cetera, et cetera. It will be tried over and over and over again. I think that eventually somebody will make it work, most likely using Ethereum, and we'll see. And I think that could be a future model for a decentralized money market system if done right. So I think that people should have, at a kind of consumerization level, a fear of algorithmic stablecoins because they're not proven. This is an academic discussion we're having, right? And it used to be 20 years ago, these things would happen by PhDs in a lab when it was client server software. And you'd write papers on it and it would get peer reviewed, and eventually it might become a product in some way. I don't know. Yeah. Now we basically release stuff to the public, get some money via token sale, and all of a sudden it's managing billions of dollars because you're giving people free money, or what they perceive as free money. And so, that's a problem, right? Because, if people really understand what they're investing in and they think it's cool and they understand the tech and they say, okay, this is worth a little bit of a risk because I think this moves the ecosystem forward, that's one thing. But if you start using it as your personal bank account, a year after it was launched and didn't exist, and the concept of technology didn't exist, and it's a completely unregulated thing because it's decentralized, you don't understand the risk you're taking, in my opinion, by definition.
So a lot of people have said, well, the only sustainable model for a decentralized stablecoin is one that's over collateralized, a la DAI. You don't buy into that. You think there's a way to do this?
Intuitively, I think that's wrong, meaning there is a way to do it. And I think it's the way I described.
Yeah.
So at a high level, if you had an Ethereum-based model where you had using a composability system where you could have a smart contract that basically pegged Ethereum to $1 and then used options, decentralized options markets to effectively short the underlying as part of the peg, that would act like a CFD, and I think Canadians know what CFDs are, Americans don't because they're illegal here. But if you could implement that in a decentralized model where you basically had like real-time settlement similar to like a perpetual on BitMEX, in theory it could work. There's a lot of theories in there, what I just said. Exactly. So that's the problem. And how do you test it in a way where you're responsible? And anyway, so I think this will be tested over and over again. And I think over the next 10 years, we'll get something that, again, I think makes sense for people who need the decentralized dollar and are willing to take that risk of the peg going, or the asset underlying the peg going to zero, versus everybody else who says, I'm fine with USDC or CADC or whatever it is, right? And that makes sense because I know what I'm getting. I it's a centralized system because the dollar is a centralized system. And for the vast majority of the people, that's probably okay. And there are a whole bunch of use cases where the risk of having a decentralized dollar actually does make sense. And I think that's how this will most likely evolve over time. And this whole discussion of algorithmic and decentralized will probably be a thing of the past in some points.
Yeah, and Alex and I, right before you came on, we were talking about sort of you could call it a collapse in the level of TVL in DeFi. It's gone from about $270 billion to 140 in essentially 2 weeks. Obviously, a lot of that's Terra and sort of the collapse there. Right. I'm kind of curious, what are the areas in DeFi that you think will sort of survive this crypto winter?
Yeah.
Which ones are you sort of most bullish?
Yeah, that's a great question. So I think that the DEX models, particularly on layer 2, are extremely compelling because you can do cross-chain potentially trades. I think the Thorchain model, especially if it eventually works on layer 2, is really interesting because it's actually adding value. It's solving problems, right? You don't necessarily want to have everything be centralized. Now, so to your earlier question about what we're seeing versus Coinbase, the exchanges, and not just to pick on them, are seeing a net outflow. We've actually seen a net inflow this year, right? And because people are basically saying, okay, one, I need to get my crypto off of these exchanges that are easily hacked and it's just sitting there and doing nothing anyway. And two, if I trust Abra and maybe one of Abra's competitors, I can actually earn yield on this and I can dig in on the risk management processes and I can actually even borrow against it. And so I think the crypto banking model is the future. And the reason I'm saying this is that I think the crypto banking model will be leveraging DeFi rails to a very large extent over the coming years for a few different things. One, more and more liquidity will become decentralized. And so for us, we don't run an order book. We basically do order routing. And so I'm excited at the prospect of being able to route orders into DEXs over time, especially in light of a lot of the SEC FUD. And so that's interesting to me. We'll always be a regulated entity from a custody perspective, but if you have these DEXs that have no off switch, that means that that whole discussion of are these broker dealers or banks or whatever just goes away. That's compelling. I think that supply chain finance, cross-border lending is a really interesting opportunity. Being able to manage liquidity for remittances is another one. Things that start to look like money market services and replacing the traditional banking rails there. This is all going to take 5 to 10 years to play out. And this blip of people taking money out is just kind of basic risk management. People just wanted the dust to settle, right? A lot of people were worried for a few hours as to whether or not Tether might depeg, even though it's theoretically fully collateralized. And there's a lot of institutions that are basically shorting Tether, not because they're convinced it's going to collapse, but because the trade is so compelling, right? I mean, it effectively costs them almost nothing to put on a trade that could have a huge return if it really does collapse. And it's not my business to be doing that, but I understand why certain institutions might want to make a small bet in that area because you could have a 10,000 to 1 return, I suppose, under certain circumstances, right?
Well, Bill, I wanted to touch base on something you said earlier, which is that algorithmic stablecoins are theoretically possible, and that what you need is an underlying asset that's not going to go to zero, and that I don't think it needs to hold value, but it's probably helpful if it does. Anyway, the reason I bring it up is because you mentioned in 2014 you created the synthetic dollar, and I wonder if maybe it's one of those things where you were almost a bit too early on that, and if now there's a more compelling case to be made for Abra to revisit that concept. And it sounds like maybe not with Bitcoin, but with Ethereum. Now, I'm just curious. Like it's not like you're coming late to the stablecoin thing. It sounds like. In fact, I now recall from interviewing you way back when for Blockchain Revolution, that was a core thing that we found so compelling, which is using Bitcoin as a rail to do remittances and cross-border payments and everything. So is this an idea whose time has finally come? Is it worth taking another kick at the can? Like, what are your thoughts on that?
That's a great question. I think that for Abra's purposes, the existing stables are functioning well. We don't really have, for our client base, a strong need to lead with a decentralized dollar.
Right.
So that having been said, I do think it's a great idea. I don't think that the problem with the way we would do it via Bitcoin was that because there was no DeFi, there was no Ethereum when we started Abra. And so we're effectively acting like a centralized dumb contract to manage the peg. There's no smart contract. It was Abra's finance team that was effectively shorting the underlying in order to maintain the peg, and we did that by borrowing Bitcoin. So then that worked fine. That's by the way, that's Genesis's business today. We helped them get into that business. Anyway, I think someone will figure this out. I'm guessing it won't be a U.S. entity, and I'm guessing it will be focused initially on markets that have an incentive to stay away from centralized bank-based products for whatever reason. Lack of trust, I don't know, conflict with legal opinions, whatever, law, war, who knows? And those incentives will be more aligned with that Ethereum-based algorithmic stablecoin, I would suppose. I mean, that's makes the most sense to me.
Yeah, well, I know that the business, Abra's got a global user base, and when we first met, we were talking about how crypto has a lot of potential for people who are unbanked all around the world, and you have to think that the idea of like a decentralized U.S. dollar that anyone can hold regardless of where you are, or if you actually have a U.S. dollar bank account, is a pretty compelling thing. And obviously, we don't have to speculate on that. Like, I think that's in part one of the reasons that all stables, centralized or otherwise, have grown so much in the last few years. Not only because they're useful as a pair for trading crypto assets, because I think a lot of people do see them as an alternative to a bank account. We just need a model that works and is sustainable. And I think that's honestly remains one of the big holy grails for the whole industry.
Right. I mean, the two assets that make, well, the three assets that make the most sense for the peg would be gold, Bitcoin, and Ethereum. The problem with Bitcoin is very simple, and that is it's not programmable. So you would need to create wrapped Bitcoin, which means you're now trusting somebody else to create a stablecoin out of Bitcoin in order to create a stablecoin out of the dollar. So that doesn't really make sense. Gold has the same problem, because in order to use a physical asset in digital terms, it's got to be custodied somewhere, and you've got to wrap it to create a gold stablecoin, which gets back to the same problem. So that's why I back into Ethereum really being the only interesting crypto out there today, or digital asset today, that could be used to maintain a peg. It's programmable. I don't see its value going to zero. It's highly liquid. And it's easily composable in these multiple contract types. So we'll see.
All right. Well, when the Abra Ethereum backed decentralized stablecoin comes out, we'll know where it started on the show. No, I'm just kidding.
In my spare time, it's what I work.
Yeah, exactly. Bill, it's so great to have you back on again. That was a really wonderful discussion. Actually helped me clarify some thinking as well about these decentralized stablecoins. Because frankly, I was in the camp of anything that's under collateralized runs the risk of a bank run, and in that case, the peg is always vulnerable. But maybe there's
you do run the risk of a bank run, but that's not the reason why.
Yeah. Well, anyway, it's been interesting, a new perspective, and all your insights on the market have been really great. So thanks for coming on. Appreciate it.
My pleasure. Always good to see you.
Yeah. All right. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.